Today I'm hanging out with Cody Touchette. He is a badass loan officer, investor extraordinaire. We're going to talk about, should that homebuyer be refinancing? Should they be purchasing? What should the investor be doing today? And what are cool loan products that can help you if you're thinking about building that ADU or mother-in-law? I'm back with my good friend Cody Touchette, loan officer, mortgage broker extraordinaire. Rates have started to move in a downward direction. And so I wanted to get this in front of our listeners. I want to talk about what this means for home buyers, what this means for investors. How do we take advantage of this? And then what are some unique things or unique products that are starting to kind of pop up that people could be using either due to new laws or rates and things like that. So Cody, where I want to start real quickly is, where are rates at relative to history? Because I've played this game a long time. Yep. I think this isn't that bad, but people who've only played real estate in the last few years, they're like, this is really expensive.
Right.
Enlighten me, bro.
Yeah, you bet. Well, that's the thing is, if you just look at the last 10 years worth of interest rates, yes, what's happening right now, you would be like, okay, I think I'll wait for them to come back to 2.75. That seems like a better place to buy. 2.75, maybe. Probably not though, right? That was caused by a global pandemic, massive amounts of money flooded into the market. I just don't see that happening again, but maybe once in a lifetime, right?
Yeah.
And so if we look at a little longer historical graph and we go all the way back to the 70s, and you look at it from the mid 70s to today, for an average 30-year fixed interest rate, the average is 7.7%.
Oh, wow.
The average.
Yeah.
So, and we just spent 10 years under that, more than 10 years under that,
Yeah.
right? And so we've come back up to arguably a little above that average,
Yep.
right? November-ish of 2023, rates were capping around at 8% for vanilla flavored home buyer, 20% down.
It was pinching the whole market.
It absolutely was. It was the moment like, hey, where are rates at? Yeah, okay, I'll wait.
Yeah,
right?
Sales literally dropped, and everyone goes, and it was that pause, and then all of a sudden rates got a little bit better, and the market started to loosen back up again.
Right. Well, it came out. There was the dot plot came out around Halloween of last year.
Yeah.
Right. And so the Fed survey of what they're kind of expecting for the next year and 2 and 3 years down the road. And they forecasted, they told us that they were probably, consensus was about a 75 basis point reduction in 2024.
Yeah.
How many have we seen so far? 0, right? But what happened the moment that dot plot got put out was our market baked in 150 basis points worth of move, in 30 days. And nothing happened.
Yeah.
Nothing had happened. Nothing was going to happen. And now fast forward, we're hoping and thinking, very good possibility in
this
September.
One's feeling like a better bet this time.
Yes. September though, right? Nearly 12 months from the time that we got the news that we were probably going to have this three-quarter point reduction, we might see one now, right? Probably a quarter, likely maybe even 0.5% in rate reduction in September, which would be great. I think it's what the market needs. Unemployment's ticking up. We need this, right?
Yeah.
The Fed has arguably been a little slow to act, which they typically are, right? They were slow on the inflation side. Now they're slow on the slowing down side. So it's normal, right? They normally do that. They act a little cautiously. But that said, historically, we're still very good, right? Going rate for a 30-year fixed, vanilla flavored buyer, probably around 6.5% right now for a 30-year fixed conventional loan. So at 6.5%, we're 1.2% below the 50-year average. So is it a good time to buy? Historically speaking, yes. The last 10 years, it's still a little higher than it was, but arguably we got lulled into a false sense of feeling like 2.75 was real, right?
100%.
And it was short-lived, right?
We've mentioned this before, but I want you to come in and nail this down for us. We've told our listeners, look at the 10-year treasury, follow the 10-year. That's what you should be looking at for real estate. Where's our relief going to come from in relation to the Fed, the 10-year, the spread?
Yep.
Which side of the coin do you think is going to give us the most relief for the real estate industry? And then give us how we should be looking at that and how we should be viewing that.
Yeah. Well, there's going to be a double whammy, right? So we're seeing the Federal Reserve start to lower long or short-term interest rates, right? So they're lowering the Fed funds rate. That in turn typically brings most other costs of borrowing down. But there was an interesting thing that happened when rates went so low. Then we refinanced all these people. People bought tons and tons of houses at 2.75. So as a mortgage servicer, right? So let's say I'm the big guy behind the scene and I gobble up all these mortgages for people and then just collect payments, right? So I don't originate anything. I'm just collecting payments. How I get paid is 0.2 to 0.25% per year on basically assets under management, right? So if I've got, gazillions of dollars worth of mortgages, right? That's a technical term. Then I'm going to get probably 25 basis points every year in income.
Yep.
And so over 4 years, I would make 25 and 25 and 25. So I basically make about 1% over 4 years. After that, the life of a loan becomes a little iffy for a servicer, right? People sell and buy another house. They refinance, they pay off their mortgage because blah, blah, blah happened, whatever, right? So the mortgage doesn't usually last more than 4 years. So then what happened was rates started spiking up, right? And we went from 2.75 to 7.75 in less than 12 months, right? Absolute game changer. And so what happened was most of these mortgage companies that are issuing mortgages in the 5 and then 6 and then 7% range, they're scratching their head. They're looking forward a little bit saying, these loans aren't going to last for 4 years on my pipeline, right?
Yeah.
Like I'm not going to sit on these loans for 4 years. So if I know that for what I have to do, right? The employees, the telephone systems and all the mail we send out to the customers for their bills and all the things we have to do, if we need to make 1% over 4 years, if I expect this loan to last 12 to 18 months because rates go up, rates come down, and they're going to be refinanced, I'm not going to get my 4 years.
Yeah.
So what they do, they stacked in that profit day one, right? So what we saw a margin, right? So this is our margin between 10-year treasury and a 30-year fixed rate mortgage. Typically for a very long time, had been around 2%.
Yeah.
So if the 10-year treasury was at 3, we'd expect 30-year fixed rate mortgages to be at 5, right? Pretty standard. Instantaneously, that went from 2 to 3,
Yes.
right? And so when 10-year treasuries hit 4, we were at 7% mortgages instead of 6% mortgages. So everybody did this all at once because they all had the same idea. All the big servicers said, no way these loans last 4 years. So now we're on that downward slide and those loans are coming off the books. And so now competition's entering into the fact.
Yes.
We've got margin compression. It was a big term in our industry a number of years ago. Now it's coming back. And so what that means is if I'm a servicer or somebody that sets pricing on origination of loans, then I'm going to say, well, hey, I'd like to get 300 basis points. My old standard was 200 basis points. These loans I'm refinancing into the low 6s might still come off the books, but now I know that these guys are taking a margin of 2.75 or these guys are taking a margin of 2.5. And so there's kind of this race back to the bottom of a margin of 2.
And that's already started.
Already started. So at the peak, it was around 300, maybe 325.
Yeah.
Now we see the 10-year treasury is about 3.9 and we see the 30-year fixed rate vanilla favored mortgage about 6.5. So that margin's down to 2.6%.
So it's already down to 2.6 from the peak of 3.
Mm-hmm.
So that's already started. That's one of the things that's causing this rate trend that we've been seeing over the last few months.
Yes. Well, and partially because we still haven't seen a Fed move.
Yeah.
Right? Like it hasn't moved yet, right? So why would you expect that interest rates are 1.5% better from the peak today if the Fed hasn't made a change? Well, there's the expectation of the Fed change. We're forward thinking, we're forward looking, and mortgage companies are saying, okay, I can trim my margin a bit and still put food on the table, keep the lights on, right? So they're able to trim those margins because they have an expectation that some of these loans are going to last longer than what they were expecting before. So that margin coming down, we've already seen some. The good news is for consumers going forward is we expect more.
Yeah.
Right. And so that double whammy is when Fed lowers Fed funds rate, we see the 10-year treasury come down more and we see more margin compression. That's why we think in the next 2 years, we could see rates with a 4 handle again.
Whoa.
Yeah.
Whoa. So explain, I really understand what you say, but I want you to say this again so everyone understands this. Give me the simple, stupid version of what you just said, because this is so powerful.
Yeah. So a Fed reduction is not a one-to-one thing, right?
Yep.
So because what the Fed is setting is the overnight borrowing rate that banks borrow from each other.
Mm-hmm.
It's like an 8-hour window, right? Like I need $2 billion because we blah, 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 whatever. As a bank from another bank, I need to borrow some money just overnight. And here it is back the next day, right? To meet their depository requirements. We're talking about 30-year fixed rate mortgages, right? That's a long time to tie up your money versus overnight. So there's some difference. But generally speaking, the Fed has forecasted they're going to lower rates this year, 0.75%.
Yep.
We might get that half of that, or not half of that, 0.5 of the 0.75 in the next 30 days, right?
Yep.
When the Fed meets on September 18th. Probably one more quarter point move by the end of the year. So that's 0.75 point. The forecast in 25 is another 100 basis points.
Wow.
And 26 is another 100 basis points. So that's 2.75 lower than we are right now today. Arguably, I think a half to 3/4 is already built in. Right?
Sure.
So if we're at 6.75 and we see them lower rates by 2% over the next 2 years, and we see this margin compression go from 2.6 down to 2,
yep,
that's puts you at 4.9.
Makes total sense. Makes total sense. So as rates change, we know that increases demand because more buyers qualify, more investors qualify. People feel more comfortable to purchase. So what is your forecast or thoughts on how many buyers will enter the market then over the next 24 months? Do you have any thoughts on that?
Yeah. There was a study done, I think it was by, I want to say it was Harvard, but I could be wrong. Every 1% rate reduction that we see in the market means 1 million more buyers are qualified to buy a house.
Wow.
Yeah. And so, in like breaking that down, right? If we take 1 million divided by 50 states, right? Like it's not a lot, but there's more buyers in Washington than there will be in Montana.
Yes,
or
of course.
Wyoming, right? So we're going to get our unfair share of those extra buyers that come in. And every 1% reduction in interest rate means that you could afford 10% more house at the same payment. And so if we saw a 2% reduction, right? If somebody's qualified for 500,000, they could get to 6 and have the same payment they were going to expect at 5. And the issue is that they might have to spend it just to get the same house if they wait a couple of years for those rates to come down.
Yes.
Right.
Yes. And so there were people who purchased at those higher rates. I'm already getting some of these phone calls. I know you're getting these phone calls too. And it's, should we refinance now? Walk us through for the listener. Should we refinance now? How do I know when to refinance? And then how do I do the math or justify to myself what makes sense when I should be refinancing? Yeah. Educate us there.
Yeah. So there's the old rule of thumb, if you will, right? Grandma told you you need to save 1% on your interest rate if you're going to make sense to refinance. Yeah. I don't know, right? I mean, it's a good number. It's a nice round number to think about, but it really depends on how much you borrow, right? Because grandma wasn't borrowing $1 million for her first house.
100% true, dude.
Right?
So true.
The bigger the loan, the smaller the impact, the smaller rate reduction you need to really impact your payment, right? Yeah. So it really depends. And similarly, we work with investors and buyers all across the country. If you bought a $120,000 home in Indiana, a 1% rate reduction on your $100,000 loan moves the needle about $90 a month, right? So, is that worth it? Probably not, right? It's a lot of paperwork, a lot of hassle. I mean, we make it pretty easy, but you know what I mean? It's stuff you have to do. And there's probably $3,000 to $4,000 worth of cost on doing that. Yeah. Now, on a $1 million loan, you drop the rate by 1%, you're going to move the needle probably $700-800 a month on your payment, and it still costs around $3,000 to $4,000 to do it. Yeah. So if it costs you $3,000 to do this refinance and you save $700 a month, you're breaking even inside of a year, right?
Yeah,
very, very quickly. Exactly. Yeah. And so I actually just did some numbers for a past client. We were debating this, and he said, I just don't know if it's worth it. I said, okay. So I said, I'll just run the numbers, right? Let's see. He's at 7.562, right? Yep. That's his interest, 7.5. And he's got a $735,000 balance on his mortgage. Yeah. Right. And so I said to him, the conventional wisdom, right? You've got to save 1%. That would put you at 6.625. Today, that would have a cost for him of about $8,000 total, including some prepaids and new reserve account for tax insurance and all that sort of stuff, and the transactional costs. And it would save him $479 a month. Pretty good.
Yeah.
Right. But he said, well, isn't it going to keep coming down, Cody? And I said, it absolutely is. Right. He's like, well, shouldn't I wait? I was like, you absolutely could wait. But now we're trying to time it. Right. And I don't know about you, but I'm not a very good stock picker. I'm not a very good timer of the market.
Yeah.
For me, it's time in the market, not timing the market. And so I said, there's another alternative. We could do this where we increase your principal balance by $1,000 and you save $371 per month. So basically what that means is we don't save a full percentage point on the rate.
Yeah.
We go from 6 or 7.5-ish to 6.95.
Yeah.
But we pay for the costs, right? And so he ends up with only about $1,000 worth of costs at that level. And it saves him $371 a month. So he breaks even in 3 months.
No brainer.
Right? And generally speaking, we don't refinance inside of 6 months anyways. So if he spent $1,000 and we refinance again in 6 months, he'd save $1,000. He'd net $1,000 better over the 6 month window of time. And I told him, I said, if we're right, we're going to do this again in 6 months. Right? And by the way, he skips a payment in the middle of this too. His payment is about $5,000.
Yeah.
So his mortgage balance goes up by $1,000.
Yeah.
But he skips a $5,000 payment. So he actually ends up $4,000 to the good on this scenario.
So that's what I love about working with you, Cody, is a lot of lenders and people, they take just the top level. You're going like 3 levels deep on this. And it's so brilliant. You're like, well, because we get to skip the payment, you're actually making $4,000 instantly.
Yep.
And that's real money.
Yep.
Because that's money that didn't come out of his checking account and then off to Bank of America or whoever it may be.
Yep. Well, and if he elected to, he could bring that payment in. His mortgage balance goes down because of our refinance.
Wow.
He'd save a few dollars extra. In his case, it made sense for him he's a business owner, made sense for him to pocket the $4,000.
Yeah.
Right. So that's a total win. And then what we do is we basically just ratchet down as rates come down. And then the cool thing is we don't have to time it, right?
Yeah.
We're doing this at and he said, sign me up for the 6-month plan, right? And I was like, I don't have a 6-month plan, but we do now. Like, I got it. We're going to do it. I'm going to call you again in 5.5 months, right? So we're going to get this done. We're going to save him, a little more than 0.5% on his rate. He's not going to pay for it. He's actually going to get paid for it. And then 5.5 months down the road, we're going to call him up and say where we're at, right? If rates have moved, we'll do it again. If rates haven't moved, we'll set a 30-day timer and just keep an eye on it, right?
Yeah.
But that way we get to ratchet down without having the expense of the refinance, right? And then we don't have to win on the timing game. I'll never probably get him the bottom of the barrel interest rate, but he's not going to go into hawk for this refinance 3 or 4 times over the next 2 years.
Bingo.
But we get the better rate every time. And then when they do spike up, because, eventually it'll happen. I don't know when. Yeah. We won't be, oh man, I missed the bottom, right? Because we ratcheted our way down. And we'll get very close to the bottom, even though we don't quite get the bottom.
This is like a weird version of dollar cost averaging your rate.
Yes, absolutely. Yep, absolutely. Oh, and one other thing, people sometimes will worry because, well, now I'm starting over my 30-year mortgage.
Yeah. And
that is true, except I also have the capability of doing a mortgage in any whole year increment we like. So he's saving $370 per month.
Yeah.
Right now he wants to, right? His payment's a little higher than he expected. He didn't, he made the right decision. He bought a house when everybody else was swimming the other direction.
Yep.
Right? He bought a house, his value's up, and now we're bringing his rate down, and we'll bring it down again. And when we get to the point where we bring it down well under his budget, that's when he could elect to take a 29-year mortgage or a 25-year mortgage. And instead of saving money on the monthly basis, he can whack time off the end of his mortgage if that's what he chooses.
Yeah.
It's it's personal preference there.
And because this is one of those ones on, like, I got this question on TikTok 4,000 different ways, and all of a sudden the views on this video just go through the roof. What would you say is the better way? Take the 25-year mortgage or take the 30-year mortgage, and then if you had extra, put it towards the principal. What would you do, or what would you tell our listeners to do there? Yeah.
Well, so I like to always look at things from a purely financial perspective.
Yes, sir.
Right? And paying off your tax-advantaged mortgage debt is never the right move financially.
Yeah.
There's always something better you can do with that money. Now, that's not the only reason to make a decision, right? Somebody doesn't want a mortgage because they feel like some people have a religious calling to pay off their mortgage. I understand that, right? And if that's your case, by all means do it. Some people have just this fear of debt. I get it. Some people want to have a lower cost of living in retirement. I get that too. Financially,
Yes.
there's always a better place to put your money than prepaying or paying down a mortgage at, especially when we get sub 6 and maybe sub 5%, right? That's a really great advantage debt. The long-term average of the S&P 500, just an ETF, vanilla flavored, you don't have to pick any stocks, is like 9.5%. So if you're prepaying a mortgage at 5, that's tax advantage probably down to 4, right? If you get your tax advantage for owning that mortgage. If you're prepaying something that costs you 4, instead of putting into an investment that earns you 9, where should you put your money? It's easier to think about it from a credit card perspective, right? If you're paying off debt, right? Because nobody likes debt. Some people are nervous or afraid of putting money in the stock market, right? I understand that. But if you had 2 credit cards and one was charging you 9.5% and one was charging you 4%, where would you send your extra money to first?
Yeah, the 9.5.
9.5. So it's the same thing when you earn 9.5 versus paying 4%, right?
Yeah.
You should put the extra money into that debt. Now, I also am a real estate investor. And so what I tell people is cash is king when it comes to being able to make a move on real estate, right? Cash is trash if you just sit in the bank account, right? But if you have it and you can go put it to work and buy another investment property, like some people just don't like stock market. Cool. Separate your money and don't put it all in this one asset. Put it into other assets. Put it into other real estate investment properties. Also, people tend to start paying extra on their mortgage. That's at, anybody that's out there paying extra on their 2.75% mortgage debt right now, give me that money. I'll give you a better rate of return, right? Like I'll take it and I'll go put it to work because it's so cheap, right? And you can't ever get it back.
Yeah.
You cannot retake that debt down the road when you're like, oh man, I wish I had $100,000 to go make an investment purchase or do something else, open a business, whatever it is you want to do. That money's sunk and stuck in your house. And the only way to get it back out is a transaction.
Oh man, I love it. That was like wisdom, the golden nuggets, because what happens is mom tells us, grandma tells us, our uncle, somebody tells us something that was taught to them that isn't necessarily how actual finance works.
Yes.
And we joke and we say, do the math.
Right.
Does it math? In this case, it doesn't math, but you also have to flip it around and say, you know what? Sometimes I'm also just making an emotional investment.
Yep.
Or I'm making an investment to live that lower cost of living. That's great. But don't lie to yourself and say I'm doing this for investment purposes.
Right. It feels good to be out of debt.
Yes.
That, right. But I always feel like my mortgage is not debt.
Yeah.
It's a tool. Right.
Yes.
And I think a lot of that wisdom, the grandma's wisdom, came from the Great Depression when people didn't have anything and they had their house and the banking rules were different then.
Right.
Banks could call you up and you were on time with your mortgage payment and they could call you up and say, hey, your note's due. We need all $5,000 left on this note, right? Because the house was worth $10,000 at that time, right?
Yeah.
We need all the money right now or we're going to have to take your house back. Because the banks were running out of money.
Yeah.
They can't do that anymore. If you make your mortgage payment, you're on time, they can't come take your house.
Yeah.
They can't call your note due because they want to and they need the money, right? So that wisdom was wise then, but things have changed, right? The rules have changed and that can't happen now. So I think personally, I'd rather put the money someplace else. The other thing too, people think it's conservative to pay off their mortgage. I don't think it is. And the reason why is you have to do a transaction to get to that money. You have to sell your house. You have to refinance or if you have to get a home equity line of credit. And I can't tell you the number of times people come to me and say, Cody, I need to do a cash out refinance. And I'm like, okay, what's going on? Right? Well, I lost my job.
Yeah.
I can't get you a cash out refinance if you don't have an income source.
Bingo.
Right? But if over the last 10 years, if they had sent that money to their investment account and put it into an ETF for the S&P 500, and not investment advice, but if they'd put it into something like that, they could call up their financial planner and say, hey, I need $20,000 to get me for the next 6 months because I lost my job. And they'd say, where do you want me to send the check?
Yeah.
And I have to say, I'm sorry, I can't do it.
Yeah.
Because you don't fit into the loan category,
Yeah.
right? So I think it's more conservative to have some money.
Yeah.
Now, if you're all set and you've got great retirement plans, and you've got great nest egg, and you've got great investment dollars, and you want to pay off your mortgage, cool. Could you still do better over here? Probably. But if you want to pay it off, awesome. If you don't have those other things all set, you've got to work on that first.
Yeah. You've got to get up that active income. You've got to increase that monthly reserves and get it to yearly reserves.
Yes.
Because on a certain level, they'd be better off just to take the extra cash, put the cash on the side, have it there in case a good deal popped up.
Yes.
And then if the good deal didn't pop up, or if they hit hard times, either way, they're there to protect themselves. If it all went into the house, it's like impossible to just claw it right back.
Right.
I want to switch gears because you're a hardcore investor. I want to think about rates dropping from the investor perspective. And so walk us through what you think in regards to rates dropping for multifamily properties, what people should be doing, numbers they should be considering, because what is so funny today is when cap rates in multifamily was at the lowest they've ever been in history because debt was so cheap. People were throwing money at multifamily and investment projects at land development. Now that cap rates have risen and they're getting a higher return, but because the debt is more expensive, they're all of a sudden all conservatives going, well, I don't know. Right. And I'm thinking, these are better assets in 2024 than they were in 2022.
Yeah.
We're getting a better return. This is a buy signal.
Yeah.
So walk me through some numbers in regards to this, and let's educate people a little bit more.
Yeah. So the really great thing about multifamily is being able to force appreciation, right? And we can do that through a number of ways, and one of which will be forced whether we do anything or not, and it's the cost of debt, right? Like the cost of the mortgage doesn't go into the NOI or the cap rate, but it's in the investor's head. Right.
Yes.
And so that's what makes them make a decision to pay a higher or lower cap rate, right? Is how much is going to cost me, right?
Yeah.
How much I need to feed this place or how much is going to make me, right? And so, yeah, if like I just did some numbers because we had a client looking for $1 million multifamily. They did 25% down if the cap rate or the rate was 6.5, the rents were about 8,000, expenses were around $2,000, taxes, insurance, blah, blah, blah. The NOI in that case was about $58,000 a year.
Yeah.
And that resulted in a cap rate of 5.84.
Yep.
Right. Which is, I think, about what we're seeing in the market today.
Yeah.
Would you agree?
Totally.
Okay.
Yeah. The whole Seattle Metro. Absolutely.
Yeah. So if instead, because rates do come down, that cap rate comes down to just say 4.5.
Yes.
Right. Which, I mean, I was seeing things in Seattle traded in the 3s.
Oh,
right.
There was a deal that we got asked to make an offer on that was 2.8 and it was a multi-million-dollar deal. So we're talking big commission for us. And I told the investor, I said, bro, I'd never buy this.
Yeah.
And he goes, seriously? I said, I understand you want to buy in Seattle.
Yeah.
I'm going to go right outside here to one of the burbs and let's just go get a better deal.
Yeah. Yeah.
That's
bonkers. Right. and I mean, some place across the country, you might say 4.5 and they're like, never. But it absolutely was like, that was a deal.
That's a good deal
in Seattle,
yes,
right?
Absolutely.
And so if that cap rate, nothing changes,
yeah.
right? Rates don't go down. You don't trim expenses, don't raise rents, nothing. That cap rate goes to 4.5. The value of that property goes up to $1.3 million.
So you make $300,000 or 30% on simply the cap rate changing.
Correct.
And the reason that cap rate starts to change is because just like the stock market, the real estate investor is a forward-looking thinker. And so as rates start to come down, they go, oh man, I can pay a little more for this property.
Yep.
And they start paying more and cap rate compression starts all over again.
That's right. Yeah. And get this, right? Like that's not a 30% increase. That's not a 30% gain.
Yeah.
It's like 100% gain.
Because
on my $1 million purchase, I put 25% down.
Oh, amen. Yes.
So I put 25% down. I'm into this thing for $250,000 for down payment. I got appraisal and title and that's maybe I'm into it for $300K.
Yeah.
And I made $300K in a year.
Yeah.
So my rate of return is 100%.
Yes.
Right? I gained 30% on the value, but my rate of return, my ROI is 100%. Now, let's say rates come down a percentage point.
Yeah.
Right? You trim expenses from 25 to 20% because you're a good operator. You raise rents from 8,000 to 9,000 and cap rates go to 4.5. Now the value of that building is 1.6.
Oh my.
Right. So you trimmed expenses by $200 a month.
Yes.
And you raised rents by
Yes.
$1,000 a month.
Yes.
And you gained another $300,000 in value. Multifamily forced appreciation is absolutely where it's at.
And so this is one of those things where, once again, I love the discussions we get into on the internet. They're like, I would never be a landlord. Just put it in the S&P 500. Where are you going to get 600 grand from your 250 grand in a year and a half to 2 years?
NVIDIA. That's probably it.
But if you were
one time in the last 10 years, yeah.
If you were lucky.
And you're super lucky, right? And you rode it the whole way, right? Because most of the time you spend you buy a stock for 10 grand and it goes to 20 grand in 2 months. You're like, I better ring the register.
Yes,
and
absolutely.
Plenty of people did. They got out and maybe they got back in, right? And then you play that game, but there's no place to do this, right? Then you talk about the tax advantages, and then you talk about the actual cash flow from the asset as well, right? It's very difficult to replicate this in a stock pick, especially when NVIDIA is one of 5,000.
Yes.
Right? Like, and there's probably a few other ones that have ripped like they have, but that's the big one in the news, right?
Yeah.
So, yeah, I mean, it's very difficult to have that kind of increase. Yeah.
This is why I love the game of real estate.
Yeah.
This is why Cody and I play together in the game of real estate. We play with all of our homies. Like, subscribe. You need to be following us, because that was that golden nugget there, is that right now we know rates are trending down, but cap rates have not started trending. And I just talked to a woman earlier today. She is getting ready to do a 210 unit site here in Snohomish County. And she said, hey, I'm thinking about starting that site here soon because I want to get started before all the debt gets cheaper and the subs get more expensive.
Yes.
And everything gets more expensive. She was like, I want to get ahead of the curve a little bit. So realize the super seasoned investor, what they're doing is they're looking further down the pipeline and they're getting moving today to capitalize on that cheap debt that's coming on. And yes, I get it that labor and materials are still really expensive, but they've come down from the peak, and get prepared to be positioned to ride the next wave.
Right. Well, and you can't refinance into long-term debt at the low rates if you're still building when the low rates get here, right? So yeah, good idea to get out in front of that. And same thing's true with, just an average buyer buying a home, right? Like, it's much better to buy when, like my customer we were just talking about,
Yes.
You swim the other direction, right? When everybody's going this way, you go the opposite way. So if everybody's pausing, that's the time to buy and get in front of it. Because I'll tell you, it's so much easier to renegotiate your rate with a refinance when you're not out there banging your head against the wall trying to get an offer accepted because there's 20 offers on every home,
Bingo.
right? And we came through that, right? Like we still all have a little PTSD from 2020 and 2021 where, houses hit the market, there'd be 17 offers. Half of the people didn't even see it because they just needed to get an offer in, right? And so homes were selling, 10, 15% over list, waiving everything. And I have a number of clients that are not happy with their homes they bought.
Yeah.
Because they bought what was there, not what they really wanted, right? Because there wasn't choices. Today, we've got our highest inventory level we've seen in 5 years.
Yeah, easy.
Right?
Yep.
So, I mean, there's more homes to choose from now than there has been in a long time. I was thinking about it just in the last couple of months. Like, next time I want to buy a house, like for me, I'm going to do it in August.
Amen.
In Seattle, because it just goes dead.
Yes.
People are enjoying I say enjoying the sunshine. It's terrible weather out today, but they're enjoying their summertime, right? They're going on hikes, they're going on a bike ride, they're getting out of town, they're doing the thing. They're not buying houses, right?
Yeah.
Like we have a number of contracts coming in, but it's nowhere near what it should be. And what's going to happen is back to school.
Yep.
Kids get in school after Labor Day.
Yep.
It's going to pop again, right?
One of our rentals right over here, brand new construction, split level. It's got high debt on it, but it's got a big chunk of equity. We're going to sell it, pay the taxes, and just literally go buy more land, build more, because we feel it and see it coming. But the funny thing is, that's a discussion we just had this morning. It's fully ready to go today. We look outside, we're like, pictures aren't going to be that good for the next few days.
Right.
Then we got Labor Day weekend.
Don't want to go on right before Labor Day weekend.
So you know what we said? Hey, wait till it's beautiful and sunny out, and the week after Labor Day, throw it on the market and we'll sell it in a week. Or I could throw it on right now and it may be stale in the next 3 weeks as that passes through.
Right.
So one of the adages of real estate is location, location, location. But a second one is timing, timing, timing.
Yes.
And if you go back and look through history, and Altos Research shows really good examples of this in their data and the Redfin Data Center, you can see the market every year heat up for the spring market. You can see inventory build. You can see transaction count build. And then you see it peak right there at the end of spring, beginning of summer, and just starts slowing down.
Yeah. With a little blip there in September, October, as head back to school and okay, we got to do this now. And then, November, December usually dies off.
The other part too, and it's now worth mentioning again, is because we're heading into an election cycle. So the election cycle also causes FUD, fear, uncertainty, and doubt. Yeah. So there's going to be a phenomenal home buying, investor buying, just buying for real estate in October, November, December of this year because of that. And so this is something, jokes aside, we wrote on the board as an affirmation, make 400 offers by the end of the year. And Jennifer was out of town this week, and she's like, how many offers did you make? I said, I made 6 and I got 0. And she goes, well, because I wasn't here. Yeah. And I said, yes, it was because you weren't here. Thanks for coming back. Let's go get something accepted. Jokes aside, though, we're going to make a bunch of offers because we know we'll get something really good. Mm-hmm. I have another one from another agent to sign in my phone right now. And we're just going to throw them out there.
Yeah.
Because somebody's going to accept something.
Sure.
Washington State, things are changing.
Yep.
So Washington State has passed their ADU bill. An ADU is an accessory dwelling unit. Think of it, that little cottage, the mother-in-law, the little house you build in the backyard, or you glue it on to the existing house. Washington passed a very aggressive one. It's been adopted in some counties and some cities already. Mm-hmm. I have 9 of them going in our development projects right now. You're getting ready to start one too.
Yep.
And you found a super awesome loan product that'll work for us here, but it also works for other states that have this too. Walk us through that, because when you called me, you were giddy like a 13-year-old boy, I have a toy.
We have a new toy. That's right. And it's not perfect and it's relatively new, so we're still learning some of the caveats. But yes, it is a fun new toy and it's built for this change of the market. Yeah. And in California as well. There's a lot of this happening in California. And I think this will be maybe not nationwide, but any places where there's affordable housing crunch, right? It's going to be an issue. So Washington specifically, like you said, by July 1st next year, everybody has to adopt this, right? So there are places where they're already seeing it, already doing it. We've got one in, I guess it ends up being unincorporated Snohomish County on the border of Edmonds. And so I hear, thankfully, we're not in the city of Edmonds because they're not ready yet. They're close, but they're not ready yet. And so what this product does is it allows us to use, this is maybe getting a little nerdy, but with a home equity line of credit, typically we do an appraisal.
Yep.
And let's say your house is worth $1 million and you owe $700,000. On $1 million value, we can go up to 80 to maybe 90% of the value. So let's say it's 80. That means we could go up to $800,000 minus the value of your first mortgage. So you get a $100,000 home equity line of credit.
Yep.
Great. But I want to build a $325,000 dadu, right? Detached ADU. Well, that's $100K is not going to get me there, right? But if I want to build this $325,000 dadu in my backyard that has some alley access, perfect setup, right? I can do with this new home equity line of credit product, I can do an ARV appraisal. So ARV is after repair value. So assuming we have already built said dadu and value the home and dadu together, and maybe that number is 1.5, right? Because you're going to spend $325 on it. Likelihood is good. It's going to be worth $500, maybe more in certain areas, right? When you're done. And so you say, well, okay, now my value is 1.5. That same 80% loan to value, you can go up to 1.2 minus the $700,000. You can get a $500,000 line of credit on that $1 million house. And so effectively, when we close on that, you have a $1 million house with a $700,000 first and a $500,000 second. So you're overvalued, which is not a good plan if you don't intend to build
Yes,
the
of
extra
course.
unit,
Yeah.
right? But that's something that didn't exist prior to, right? So now we've got this budget. And the really cool thing is this is not a construction loan. It's a HELOC.
Yeah.
And you'll get a checkbook. And when it's time to pay the contractor $40,000, you write a check. There's no inspection. There's no draw. You are in control.
And everyone's missing. So I want to make this like really clear. What happens is when I'm building a home, I pay the bill.
Right.
Then they come and check to see if
right.
the bill I paid was completed.
Right.
And then I get a release from the contractor. So I paid it, the bank checks it, and I get a release. Then I give it all to the bank. Then they reimburse me.
Right.
So it's a 30 to a 70-day cycle to get the money back. And what Cody's telling you is, hey, we're going to give you a checkbook, and you'll just go, Phew.
Right. I know.
Love it.
Yeah. So killer product. It is a home equity line of credit. So it comes with a 10-year draw period. So you can draw on it, pay back, draw on it, pay back, just like any old normal line of credit for 10 years. And then after the 10 years, it goes to be a 20-year amortizing loan. So it's still a 30-year mortgage. The rates are very variable, dependent upon credit score and loan to value. But the lowest I saw was prime plus 0.5. And so prime today at 8.5 would put you at 9 on the best setup there.
Which is cheaper than a lot of construction debt.
Certainly, yes. And there's not continual fees as they go out and see things and do the draw and all the other things, right? No fees
because I don't got
those.
to pay for the inspection fee. I don't got to pay for an additional appraisal fee.
Correct.
Wow.
Yeah. The cost on that loan is 2% of the line amount. So if you got a $500,000 loan, it'd be $10,000.
Yep.
That can come out of the balance of the mortgage. You don't have to prepay it. And then $2,000 worth of appraisal, title, escrow, that sort of stuff. So
easy peasy.
yeah. So if it's a $300,000 line, $6K, probably $8K total, $500,000 line, probably around $12K total. So also pretty great compared to what you'd pay for a construction loan, right? The other thing where this could be really great, right, is that that's assuming, like, this is a cool product, assuming somebody just bought a house.
Yeah.
But it's really cool assuming somebody bought a house 3 years ago.
Tell me more about that.
Well, because if I bought a house 3 years ago, I have 2.75.
Oh.
I've got a spectacular rate on my awesome mortgage.
Yes.
I don't want to see that go away. And generally, without this type of product, what you have to do, if you're going to build that dadu and you need money and you need the ARV, you got to do a construction loan.
Yeah.
And you got to take out, you got to erase that old debt at 2.75. And now you got a bunch of new debt at 7, right? Instead, we get to hold on to the existing debt at 2.75 or 3, wherever you're at, and we put a new piece of debt on it, right? And so I think that's really valuable for somebody that's kind of been biding their time and they've been waiting for this law to come in, and maybe they've been saving up some scratch because they thought they were going to have to fund it out of their own money. So this product could be really good to unlock that. It also can be used for renovations too, right? If you just want to fix up your house.
This is phenomenal. So what we should be looking for, or how we should be doing this, is you work with Cody, you work with us, we go find a project where it's got I'd even like to find an okay house, not even a prime house. We get a okay house. We renovate that a little bit.
You can build the renovation of that house into it as well, as long as there's budget.
Yeah, so we renovate that one a little bit to build equity there. We build 2 dadus in the backyard.
Yep.
Turn around and refi the whole thing. We might be able to burr our way right out of that bad boy.
Yep, sure could. Or possibly condo it and sell them all individually.
Amen.
Right?
Amen.
If you want to, if you're looking to build investments, absolutely. Refinance it, keep it, move on. Or, I think there's probably $100,000 to $200,000 in each of those dadus.
Yes.
And maybe you make $50,000 to $100,000 on the house.
Yeah.
So you do one of those a year, you can make an extra $500,000.
Oh, wow. That's gangster. Yeah. Cody, what else should we be talking about, or anything else on your list that you wanted to go over today?
Yeah. I mean, I think we kind of talked about it a little bit, like just the fact of like average home buyer out there that's in the FUD moment, right?
Yeah.
Like there's an election, rates are still kind of high. I think I'll wait it out, right? Like the important thing to understand is that the money's made when there's blood on the street, right?
Amen.
When
Amen.
when the fish are swimming downstream, go upstream, right? Just go opposite of what everybody else is doing. And right now, people are on pause, right? There's a lot of folks that are sitting on the sideline. And so I think if you jump in now, arguably the time to jump in would have been November, December last year.
Yeah.
Right? Because those people that bought in November, December, they're already refinancing into the mid 6s.
Yeah, and they already have equity.
and they've got equity. That's
Yeah.
right. Because they bought when nobody else was buying, right? It was literally needle off the record, no chairs left. Where do we go, right? Mortgage guys are like, what do we do for this month, right? So I think this is still an opportunity, right? Because there are people out there that are waiting till rates start with a 5 or start with a 4, right? And the problem is that as you wait, those home prices go up.
Yeah.
Competition goes up. And then you might get into the position where, like we were in 2020 and 2021, where you're losing out because you're only bidding $50,000 over on an $800,000 house, right?
know.
And right now you can buy a house at list.
Yeah.
You could probably get closing costs covered in a lot of cases, right? And so that competition's way down, so the deals are there to be had. And I think when we do see those rates come down, we're going to have natural appreciation just because it's real estate and it appreciates. We're also going to have a little bit of forced appreciation when you see those rates come down and we see all those people come back into the market.
Yeah.
So I think if you said, well, I'm going to wait for rates to drop 1%, I would say, what do you think is going to happen to real estate prices in that same window of time? And if you look at Snohomish County, right, our average rate of appreciation over this window of time, over 63 years, has been 5.5%.
Yeah.
In Snohomish County. The last 5 years has been 7.5%. The last 1 year was 9.15. Just whole of Snohomish County, right? So if you waited,
Yes.
because you were waiting for rates to come down 1%, but the home price goes up 9.15%, you actually only make a little bit of difference, right? And like, again, natural numbers, right? Let's say, again, it's easy math, $1 million house, right? That $1 million house goes to $1,090,000. Your rate goes from 6.5 to 5.5. If you wait to buy, the payment's nearly the same.
Yeah.
If you buy today and refinance to 5.5, you can save 1% on your rate, which would save you probably about $700 a month on the payment. But if you wait, there's no possibility of refinancing because you waited and you got the rate you were looking for, but now you got to pay more for the house.
Yeah.
And you don't actually make any headway.
Yeah. And there's no way to change the principal amount that you're paying for the house.
No, you can't. So after you make the purchase, you can't renegotiate the price you paid, right? But you can renegotiate your interest rate in the form of a refinance, right? So nowhere in the world has anybody bought a house and then 12 months later somebody comes back to you and says, "Oh, you owe me $90,000 more because the house went up in value," right? That doesn't happen. But you get that $90,000 in value. If you don't buy, somebody will absolutely ask you for $90,000 more for that same house a year from now.
100%.
Right.
Cody, love you, man.
Oh, thanks for having me, bud.
How can people get a hold of you? Where do you work out of, all that jazz?
Yeah, you bet. I'm based out of Kirkland, Washington. We work in 35 states across the country. So we have lots of different places where we can help people buy houses. You can get me at 206-909-2007, or our website is thetouchetteam.com.
Awesome. Thanks for having me.
Yeah,
No, thanks for coming.